To understand this fee business, I went to talk to someone who has thought long and hard about it. Jack Bogle, the founder of Vanguard, a company that offers some of the lowest fee products on the market. He says that if you want to improve your retirement outcome, make sure to minimize Wall Street's take.
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get. The money managers always want more, and that's natural enough in most businesses, but it's not right for this business.
Bogle gave me an example. Assume you're invested in a fund that is earning a gross annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. Bogle says you've lost almost 2/3 of what you would have had.
What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us.
What I have a hard time understanding is that 2% fee that I might pay to an actively managed mutual fund is going to really have a great impact on my future retirement savings.
Well, you have to rely on somebody to get out a compound interest table and look at the impact over an investment lifetime. Do you really want to invest in a system where you put up 100% of the capital, you the mutual fund shareholder, you take 100% of the risk, and you get 30% of the return?
I wanted to know how others would react to Bogle's claims. J.P. Morgan Chase offers more than 100 mutual funds that charge anywhere from less than half of 1% to more than 2.5% annually. I want to get your reaction to an example that Jack Bogle gave us, and that is that if you invest over a 50-year investing lifetime in a mutual fund, making 7% a year on average, but you're paying 2% in fee for that, that 2% will erode something like 2/3 of your gains.
So the lower fees relative to any given investment will always result in higher accumulation.
But is his example correct? I mean, it's shocking that you would be giving up 2/3 of your...
So I don't know the math behind the example.
But does it sound correct?
Citing. It sounds high.
It had sounded high to me as well. So I took Bogle's advice, found a compounding calculator online, and used a simple example in order to isolate the effect of fees. Take an account with a $100,000 balance and reduce it by 2% a year. At the end of 50 years, that 2% annual charge would subtract $63,000 from your account, a loss of 63%, leaving you with just a little over $36,000.